It's Coffee Fridays with your mortgage man, Eric. Cheers. So today, we're going to talk about the different options of finding your lender. Which lender do you find? What kind of lender do you go with? There's 4 different options that you guys can choose from out there. This may make some of my competitors a little upset with me, may make some of my competitors very happy with me. Let's get into it. So, let's talk about the first, right? The FDIC lending institutions, which are some of the worst that you could go with, and here's why. The FDIC lending institutions, they were exempt from a bill that was passed back in 2008 called the SAFE Act. That was an attempt to clean up the industry after the housing recession, right, and the mortgage implosion and all that stuff that happened back after the subprime meltdown days. And it didn't get implemented in 2010, but in that SAFE Act, it made lenders, loan originators go back and get educated, pass testing, federal test, state test, FBI background check, fingerprint, licensed and bonded and insured. So that changed the industry for the better, but because of politics and the big banks, the big banks will stroke any politician, right? Doesn't matter which side of the fence they're on. And they were held exempt from this law or policy that was placed. Interesting, right? Most consumers aren't aware of this. You would think that it would be reversed, right? That the big banks would be held to higher standards, but they're not. In fact, it's been dumbed down, they're watered down. They do not have to do any of those requirements, unfortunately. So you as a consumer have to know that. The big banks, they don't do mortgages well. Credit unions, big banks, anybody that has, is FDIC, right? They can take monies for deposits and have checking accounts, savings accounts. Any institution like that is an FDIC institution. That's not what they do well. They do not do mortgages well. That is not their primary function on zoning in or honing in on top-level service. So you have to understand that. So with that, your realtor partner or your realtor that you've hired, if you're a consumer, will tell you this. Can you use them? Sure you can, but it's going to be a train wreck for a transaction. They're not going to be able to get a hold of them. They won't know who to get a hold of because they don't process your loan at that facility. Heavens no, they're going to send it to some facility in the Midwest, probably some huge call center type of facility where all the processing and underwriting is done for that particular bank. And you're going to talk to 3, 4, 5, 6, 7 different people in that transaction. You will not have one liaison. You won't have one go-to person. It will be a train wreck. And same with the realtor, and that's why they don't like to use them. Now, I'll give you an example. If it was a bidding war or you were just facing one other bid, and let's just say that the bids were identical. Let's just say that we're both FHA loans and the credit scores were the same, the down payment was the same. They're identical offers, other than offer A is using a local direct lender and offer B is using a big bank. You know which one's going to get approved? Not the big bank. And it just is what it is because the listing agent representing the seller also knows that it's going to be a train wreck. Highly doubtful it's going to close on time. We're going to need an extension to close of escrow. The appraisals don't get ordered for a couple weeks. It's just, they do a number of things bad within that transaction, okay? That's the first caveat of lending out of the 4. The second is what we call the sweatshops. Coffee Friday. What we refer to in our industry is the sweatshops, and they are your big call centers. The ones you see on television during the Super Bowl commercials, if you follow me. And they're terrible because they're sweatshops, and they're usually operating underneath of a DBA from a big bank. So they have some exemptions that are built in to what they've got to do as well. So they have high turnover, boiler room mentality, sweatshop. Cubicles, young kids, drilling the phones, and they usually aren't there in 2 months, or a month later when you go to close your loan. They also have a difficult time on closing on time. Your realtor will also tell you, please don't use them. It'll be a train wreck for them and you. But you can get 1/8% better in that interest rate. Right? And look, I get it. There are going to be some folks out there that think that that's the only thing. I need the best interest rate that the internet can give, right? And internet lenders are just like, they fall underneath the same category as sweatshops because it's the same concept. You never meet them. You can't meet them. There's no one go-to liaison. There's no mortgage loan license originator that's going to take on your file and be the point man from start to finish. Realtors can't stand that. When you go to an entity like that, it's going to be a nightmare, a train wreck, a headache, you name it. So keep in mind that getting 1/8 better in interest rate is not always what it's cracked up to be. First off, you got to get across the finish line, right? That's the most important thing. You're involved with a legal contract. You have an obligation to close on time. It's not a suggestion or a recommendation. You are contracted to close on time. So the lender that you pick, you have to make sure they have the capability to not only guiding you through the process, but doing it on time. So you have to keep that in mind. A third or 3 out of the 4 is your brokers. Now, brokers are kind of a thing of a past. Sure, there are still some out there. They were a thing of the old school method and old school ways, right, back in the subprime. They typically are your one-man shows or husband and wife show, very small type of office, and they usually work from home. They're a middleman. Benefit from using them, you may get a better interest rate, but they're nothing more than a middleman. They're going to be submitting their loans to entities such as myself, which we're going to get into as the fourth and final kind of lender that's out there. So you have the broker. There aren't too many of them, so you probably won't run into many of them that are out there. Limited viewership and what have you. So fourth and final, it's what we refer to as the direct mortgage lender. And that is someone like me. And I could be happy to give you a list of my competitors. I'm not going to do so on the video because I'm not going to plug them. But we are people that are typically local, typically do everything local, underwrite your file locally, process it locally, what we call doc and prep it locally, fund it locally. Everything's basically done locally, supporting the local market, and that's all we do is mortgages, and we do it quick, and we have relationships that are set up with the realtors. We respond quickly. We work on the weekends. We work on the evenings, and yes, our rate may be 1/8 higher than the sweatshop lender, but we get it done. We're a true professional. You're going to talk to me and me only throughout the entire transaction. You're not going to be dished off to Bonnie, Susie, Carl, Johnny, and your head is spinning. You don't remember who you've spoken with. So keep that in mind. With that said, they are your 4 different types of lenders that you can choose to do business with. Ask your realtor. Your realtor will usually have somebody that they will recommend you to. And even if you don't want to use them, use somebody within our sphere, within our caveat of lending. And here's the thing to take from this, okay? Most people would never look at their 401k or their finances or their portfolio as a drive-through. I'm going to look for the financial advisor who has the lowest commission percentage or the lowest fees, right? You don't do that with your financial advisor. Why? Because they're handling your monies and some of the most important things of your life. Well, a mortgage is the same way. It's one of the most intimate, personal, financial transactions you will ever go through in your life. And why you would want a drive-through mortgage that you have absolutely no understanding of who's really handling your mortgage is beyond me. So keep that in mind. Think of a mortgage like a financial advisor, your mortgage guy like a financial advisor, and you'll get the understanding of it, right? That's where it needs to be. It's not the bottom basement deal. Now look, if you're doing a refinance, it might be a little bit of a different story. And if you want to choose one of those internet lenders and go through heck, right, and take 3 months to close your refi just because you got 0.1 better on the rate, okay, great, because you're not under a contract to close, right, for the refi. But on a purchase, oh man, for the love of mankind, make sure you choose the right lender. Stay away from the sweatshops, stay away from the FDICs, and choose your local direct mortgage lender. Support your local market, right? Everybody's like, oh, you know, support the local guys, support your community. But then they go and they bank with the largest bank in the world. And they go through a mortgage through the biggest bank in the world, not knowing that they're the worst level of service to get a mortgage through. You know what I mean? It's kind of puzzling, and I get it. Most consumers don't understand that. But that's why, you know, hopefully I put some of these educational videos together. Coffee Fridays with your mortgage man, Eric. Have a great weekend. Cheers.